When that education bill shows up one day, do you want to be in a position of control or do you want to be in a position of being under pressure? A lot of us have probably been taught to think about education as a savings problem, right? How much should I save? Where should I put it? Will it grow enough? But what if education's not a savings problem? Money doesn't just sit, it's constantly moving, it's constantly flowing, and we finance everything in life. So education is a financing problem. And who controls that flow and financing in your life? Now, I just want to start the night just recognizing this man. So, our Nelson Nash, and just just being completely real, this man changed my life. And anyone that was blessed to know him or read his book, Becoming Your Own Banker, has been influenced by him. And so one of the things that he would say, and one of his core principles is everything begins with the way that you think. Everything begins with the way that you think. And there's just, if you think about our culture right now, there's so much noise out there, right? You go on any social media, you go on the news, you watch any of that stuff. There's so much noise trying to demand our attention. And there's noise around this topic of money, and what we need to do. And so tonight, my goal is not to just add to the noise. I'm not going to try to tell you what to do. But what I want to do is invite you to take a step back and let's just spend this time that we have together really taking some time to think about our thinking. The fundamental truth when it comes to money is our money has to reside somewhere, right? Money comes in, we have to put it somewhere. And so if you think about where we store that money, is it safe to say that typically we're either saving or borrowing? We're storing that money in maybe an asset, or we're using a government type of saving education plan. Is it fair to say, and just type a Y in the chat box if you agree with this, is it safe to say that typically where we're storing that money would fall under one of these three categories? Is that fair to say? When we think about where to store money, it's not like there's a bajillion different places we can do it, right? And I think it's fair to say that it's typically, going to fall under one of these three, we could do four categories. And so, since we've kind of established some ways that we can save for the child's education, why don't we take a bit of time and we're going to dive a little bit more into each of them. And then we'll just look at, an alternative way to access money for education. And so would it be okay with you all if we just, if we compare them tonight and just take some time? We're just going to compare those different ways. And to do that, I thought what we would do is use three different families, okay? So we'll talk about, family number one, we'll talk about family number two, and we'll talk about family number three. And let's just assume that they're all very, very similar. So maybe they live in the same city, similar incomes, they hang out at the same places, and since for me, I have my two older kids are girls. So let's just assume they have a daughter that they want to attend university one day. Okay, and so we'll also assume that they sat down, they had a family budget meeting, and decided they could start setting aside $250 a month for education from the day they were born until that daughter turned 18. Okay, does that sound good, Jeff? That hopefully I explained that well and that made sense.
No, that make good sense. And maybe they also all have Costco memberships.
Okay, perfect. Yeah, they all have Costco memberships. Okay, so what we're gonna do, so family, we're gonna go like this. So family number one, let's have them, they're gonna focus on saving and borrowing. Okay. Now I'm gonna jump over here and let's say family number two, they're gonna focus on the government education program, whatever that may be. And then family number three, we're gonna have them kind of in this asset category, and we're gonna talk about they chose to build a family banking system. So we'll get a little bit more into that later. So let's start with the simplest one here. Okay, so I'm gonna move down. Okay, so let's start with number one, with family number one. And so they're going to be, they're going to be saving cash. So, they got their money line here. This is our time, all the way up until age 18. And, let's say they're putting aside, like we said, 250 bucks a month, and it's just going into an account. So now if you kind of look at that and you do some math, after about 18 years, there's going to be about $54,000 in there. But then the daughter, she needs that money for the school. So what's she going to do? They're going to spend it, right? And then what happens to that account? Goes down back to zero, right? That's pretty standard for we save and save and save and save, and then we need that thing. So in this case, it's that education, and then we spend it and it's gone. And so would just love to hear again in the chat box, when you kind of think about funding your kids' education this way or your grandkids, I'd love to hear what are some of the benefits that you can kind of see in doing it this way. Okay, I see some of them there. So low risk. Dan says no benefit. Yeah, Darcy, no student loans, liquid. Awesome. It's simple, right? It's accessible, right? And kind of what Stan there said there at the end, right? It's liquid. It's you can access that. Now, when you think about the downsides to this, right? If you think about downsides of saving cash over a long period of time, what would be some of the downsides to doing it this way and saving the money? Now here's something to think about, okay? You're putting that money aside, so let's just say you're putting it in a bank account. Now, that money's sitting in your bank account, so technically the money's sitting in your bank account. Who's that money working for? Because, money's always flowing, right? It doesn't stop moving, right? Because the money's not actually sitting still. It's, we put in our savings account and there's a number on our ledger that says this is how much money's in our savings account. But, the banks are taking the money, paying you very little interest, and then lending it out to others who need it and charging them a higher interest rate and keeping the difference, right? And then the other piece is, where does the money go when you spend it? It's gone. You can't reuse this money again once it's gone and paid for the education. It's not going to continue growing again. You can't earn interest on it again. You save it, you spend it, and then it's gone, right? Now let's assume for a second here that there's not enough saved. Okay, so the daughter has to go out. She has to get a student loan. And then what happens after she borrows it? Eventually, she's got to repay it. Yeah, thanks, Lisa, right? She eventually has to repay it. And what's she doing? She's paying interest to somebody else. And when she's doing this, who's really in control of the terms of the loan? Is the banker. Yeah, 100%. So she pays it back over time to somebody else, pays them interest, making them more money for the use of their money. So when you think about, student loans, and I got some more questions. I'm loving the engagement. Thanks so much for in the chat box. So when you think about, student loans and accessing money this way for education, do you see any benefits to borrowing? Right? So type in the chat box. Are there any benefits to doing it this way? And yeah, it's true. There is downsides to this as well. And, over that time that she's paying that back, again, she ends up back at that zero spot, right? Where it's she borrowed the money, she got the education, but then she had to pay that back and ended right back up to zero. And going back to Nelson Nash again is one of the core ideas that he taught is this is every decision you make with money is a financing decision. You either pay interest to somebody else, so in this case it's borrowing a student loan and paying that interest to somebody else, or you pay cash for things and you give up the opportunity to earn interest on that money ever again, right? So you think about it, that money is spent. You can no longer earn interest on this cash anymore. It's gone. So you've given up the right to earn interest on that money. or you're paying interest to somebody else. And so every decision we make with money is a financing decision. Another way to say it is you either pay up interest or you give up interest. And that applies to how we fund education as well. So in both of those saving, in both of those scenarios, think about it, whether it was saving or the bar or borrowing, who was it that benefited the most? Yeah, banks, right? It's you do all the work to save the money, but in the end, the bank ends up with all your money. And not because we did anything wrong, because we're doing what we're taught, but because the bank controls the process of banking in our lives, right? So the real question becomes who controls how we finance the things we need in our lifetime? And for a lot of people, it's the bank, right? So let's move on to family number two. Okay, and so this one is really the government education savings plan. And so I know we have some Americans here on the call. So I'm in Canada, and so for us Canadians and all my fellow Canadians on the call, for a lot of us that's the RESP, the Registered Education Savings Plans, and so it's federal, but some of the provinces have additional programs you can qualify for, but it's typically just some form of savings government structure. So we got our timeline, right? Time's gonna pass anyways. So there's our timeline. And so how, typically how these government savings plan would be structured is, you're putting your money in. So whatever that amount is. So we'll just say, for the sake of the conversation, like we said, this family's putting in $250. And then the government comes along and will put in, however much that is. They'll match, or different places have different things that they do, but the government will come in and the forms of grants or something like that will put in some extra money. And then, the hope is that it continues to increase and it continues to grow. Now, Jeff, you want to hop in here for a second for me?
Sure.
Awesome. Okay. So Jeff, if this if you're investing money, can it ever go up?
Sure, it can go up.
Okay. So potentially if this RESPs or is in Canada or the 529 Mike said in the States, if it's invested, it could potentially go up, right? So
Mhm.
so Jeff, can investments go down?
Unfortunately, yes, they can.
Okay. So, potentially there is that risk of it going down, right? If it's invested and market goes up, market goes down. So over time, you hope that it increases, but I don't know about you, but I can't control the market. So the investment side of it can go up, it come go down. Now let's just assume that everything was perfect for this family, and we lived in a perfect world. The government chose to make the best choices with that money. They picked the very best investments, and the market never went down. And we'll just pick an average interest rate, but let's just say for the sake of the conversation that this savings plan earned, we'll just say 4% a year, just to keep it kind of simple. So now if you look at it, there's different pieces going on, right? So there's what you contributed, so $54,000 over the time. In Canada, there's our RESP grants, which the max is $7,200 for the lifetime. And if the investment piece of it earned that 4%, then we're looking at about $28,000, almost $29,000 in growth over that time. So theoretically, in a perfect world, this investment grew to just $89,000, just for the sake of this conversation. Okay, so now that the daughter, um, she goes to school, she has access to it, and again, same thing, right? She accesses the capital, pulls it out, and uses it to get her education. But what happened to the capital? It's gone again, right? Now, when you look at it like this, how it's, how it's kind of drawn out of what potentially could happen, um, type in the chat, what would the benefits be of using a government savings plan for a child or grandchildren education? Now, let's take it a little bit further, right? What happens if she decides to delay going to school? The program can still go. It's still going to be there, but she may decide to just, hey, I want to take a year, or I want to take some time, and then maybe what happens even if she decides not to go to school, right? And like I said, I don't want to, criticize the tool. It is what it is. It's a tool, but not everything goes exactly as planned, right? And so in that case, who's really in control is the government. Someone else is in control. And so if you're on the call and you have an RESP or some kind of savings plan, first of all, I want to just tip my hat to you because you cared enough about your kid or your grandkid that you took action and started something for them. And that's incredible. I'm a little bit curious, is anyone on the call, maybe you've had a program and for either a child or a grandchild, and who did not end up going to school? And if you're willing to share, I'd love to, type it in the chat if there's someone on here. Okay, we got a yes in there. Okay. So now in just like a few words, if you're willing to share again, what was the experience like trying to get that money back when they didn't go to school? I was recently chatting with someone, and they were going through this very scenario, and the words they used is it was very painful. And we can't predict the future, and that's uh, a potential thing that could happen, right? So let's talk before we jump into family number three and the family system. Let's take a look at how money flows in most of our lives. So let's just say, this is you, and you go do work or whatever it may be, and you have that money that flows into your life, right? You work hard, the money comes in, and it's constantly in motion, right? So isn't that money then going and flowing away from you? Doesn't it feel like a lot of that time? So when you think about, just yourself right now, where all, that money seems to be constantly flowing out. What are some of those things in your life that, money seems to always constantly be flowing to? So just again, dump that in the chat box. Love to hear some of those things that come up for you. See, okay.
Yeah, we're seeing retirement, taxes, kids, bills. Yes. Vehicle repairs, living. Yeah, absolutely. Rent,
Yeah.
food, bills. Yep. Mortgages, travel.
Yeah, it seems like all these things, right, are flowing away from us we, as soon as that money comes in, it seems like it just flows right out. And then, hopefully we're able to take some of it and, put some of it aside, right? Whether that's for, like we've been talking about tonight, whether education, retirement, something that we're hopefully able to set aside. But it constantly seems like the money's just coming in and then flowing out. And so for the majority of people, right, it's money flows in, but we don't actually control it or where it ends up. And then every time money flows out, we're financing something, right? We're either paying interest on some of these things, right, like the vehicles or the mortgages. We're paying interest to somebody else, or we're giving up the ability to use that money in the future to earn interest. Because you know what we do? We go back out and same thing. We work hard again, money comes in, and then it repeats the process. So yeah, lots of whys there. Now, let's bring this back and think about, your children or your grandchildren or, the future next generation in your life, right? Whether it's kids, nieces, nephews, whoever's coming along behind you. Let's look at family number three. So they took that same, time passed, just like for everybody. They took that same 250 bucks a month and started building a system where they could start to control the banking function in their lives and how they financed the things that they all needed with access to capital on their term. So instead of, putting it into savings, instead of putting it into the market, instead of putting it into a government plan, they chose to just flow that same 250 bucks a month into their family system. And by doing that, they pay or just paying premium into a properly designed, participating dividend paying whole life insurance contract. And immediately when they were doing that, something different happens. So from day one, they created a guaranteed tax-free death benefit. So in this case, it's just over 200,000 in that case. Okay, so 217 865 tax-free death benefit. And now that number, the way that's structured, that number is going to grow over time. And at the same time, what they're doing is they're building access to capital in the form of cash value, right? Because contractually, by the time this girl reaches age 100, that cash value has to be equal to the death benefit. So it contractually has to grow each and every single day until she reaches age 100. So every single day, regardless of the market, regardless of inflation, regardless of anything going on, that cash value must grow. So at age 18, if the child chooses to go to school, so now how this is going to be designed is this we're going to increase this death benefit constantly over her lifetime. And so what that does is now that cash value has to increase every single year. So now when she gets to age 18, this death benefit will have grown to $651,000, 775, right? That's the power of time and compounding. If you think about that growth, right? This growth that's happened over time of that cash value, how much cash value do you think the family would have access to by the time she reached age 100 um, and needed it for school? So access to $65,000 of cash value on demand on their terms for their child or grandchild's education. And since, the mom or dad or the grandparents, they're in control, then when the child finishes, college or university and starts making an income, then she can start paying back the family system. And that's a more peaceful way of life where you're in control of paying for that education. Now, doesn't that sound like the control that we talked about at the beginning? And so, family number three, they didn't commit their money to one outcome for education. They built a system that works no matter what happens. So, three different families, three very different outcomes. But what I wanted to kind of do is, maybe for some of you on the call, you think, maybe 250 is a lot right now, or maybe you're kind of thinking, hey, that's I want to put in more, right? Like where do I go? Where do I sign up? Or maybe you don't even know how to start. Um, those are all valid points, and here's what I've kind of seen over and over and over. A lot of people don't start because they think they need to either start bigger than they can, or maybe they don't know how to start, or they think they missed the boat and it's too late. And so they kind of don't take action and they just kind of wait, and then the time passes. But the most important decision that we can ever make is when we start doing what we know we need to with what we have with where we're at. And so I wanted to kind of put my money where my mouth is, so to speak. And so I want to just show you something here, if that's okay. So this is my family. And it's a little bit of an older picture. I'm not gonna lie, it was from last summer. Because I don't know if you know, but uh it's really hard to get a good picture when you have a teenager and a toddler. So don't judge me on this being an old picture, because actually we added this adorable little handsome fella this last year, and we don't have an updated picture yet, but actually 6 months old today. So we added this little handsome man 6 months ago. And so when my youngest daughter was born, we started policies on our girls, and it wasn't a huge amount. So we just did, we did $50 a month each because we just wanted to get started. And so our girls are 10 years apart. So when we started the policies on our girls, my youngest daughter, she was 2 months old, and our older daughter was 10 at the time. But you know what? We didn't look at the older one and be like, "Oh, you know what? It's too late for you. So we're just not going to start anything on you." No, we didn't want to do that, right? We wanted to start where we were with what we could. And so at the time when we started this first policy, it was $50 a month. And so now we have two systems started at the same time. And are they going to look different? Yeah, 100%, right? My toddler has some more time to catch up to my older one. But the thing is that they were both started. When it's time for them to go to school, or when it's time to buy a car, or when it's time to get married, I don't want to think about that one, but when it's time to get married or buy a house, there's going to be a pool of capital that we can access on our terms for them that they can pay back according to what we work out, right? Because we're in absolute control. So when they are 18, right, we have access to capital on our terms. We started, and being able to access 12 grand to pay for a college year or whatever it may be, right, is going to be a more peaceful way of life, right? And you know what? If they don't go to school, then they can access that capital for whatever path they may take. It's not necessarily about starting big. It's just about starting. And so every single year, we have access to more and more capital on our family's terms. So when we take a step back and look at everything we've covered, there's really three ways we can approach education. We can save or borrow, you can use a government plan, or you can build a system. Same discipline, three different structures, three different outcomes.